Okay, let's dive in. We're looking at something a bit paradoxical today in the design software world. Figma, their third quarter results just dropped, and, well, the stock jumped 4% after hours. Investors seem thrilled, but they also reported this huge net loss, over $1 billion. So our mission today, make sense of that. We need to dig into the numbers, figure out what's actually driving growth, especially around their AI stuff. We want to pinpoint the product, pulling in new customers, and, explain why this massive loss isn't scaring the market away.
Right. That paradox is exactly why this is so interesting. You've got these really solid operational numbers on one side, a good revenue beat, great margins, but then bam, this $1.1 billion net loss grabbing the headlines. It really highlights the difference between, let's say, accounting figures and the actual health of the business underneath.
Okay, so let's start with the good news then, the operational side. The financials looked pretty solid, didn't they?
Yeah, definitely strong.
They reported revenue of $274.2 million for Q3. Now, Wall Street, the L-side consensus, they were expecting closer to $265.2 million. So, a decent beat there.
A very solid beat. And that means growth was really humming along. We're talking 38% year-over-year revenue growth in the quarter. That's really strong, especially, when things are tightening up economically. Lots of software companies are seeing slowdowns.
38% is definitely strong. High growth, beat expectations. But then we hit that wall, that headline loss figure, a net loss of $1.1 billion. Yep. That works out to $2.72 per share, which is just huge compared to last year. Last year, the loss was only about $15.6 million. So for anyone just looking at that, it's a massive jump. How do we square that?
That's where the context is absolutely crucial. That enormous loss, it's almost entirely down to one thing.
Yeah.
Stock-based compensation, or SBC. It's a non-cash expense. It doesn't reflect the day-to-day operations. If you look at their adjusted earnings per share, which pulls out charges like SDC, Figma actually made 10 cents per share. Profit.
10 cents profit adjusted versus a $2.72 loss unadjusted. Wow.
Exactly. It shows you how much that one accounting item distorted the picture.
Okay, but stock-based comp.
Yeah.
That's always there for tech companies, right? Why did it suddenly shoot up to $1 billion this quarter? Was there some big event?
That's a great question. It likely points to something like accelerated vesting schedules, maybe tied to hitting certain performance goals, or perhaps just milestones after their IPO relatively recently. Sometimes pre-IPO stock options fully vest once the company's public, and that triggers a big accounting charge all at once. What it really tells us is that management is using compensation, stock, heavily to keep employees for the long haul. They're basically taking an accounting hit now to make sure their key people stick around.
So it's not like they're burning cash running the business day to day. It's a paper charge connected to keeping the team.
Precisely. It's about investing in talent, and the underlying business health supports that kind of strategy.
Right, because the other metrics look good.
Absolutely. Look at how efficiently they're running things. The adjusted operating margin was 12%. Street accounts consensus, they were only expecting 6.5%.
Wow, almost double.
Yeah, beating expectations by 5.5 percentage points on margin. That shows the core business is extremely efficient, very profitable. It explains why the market is focusing on those adjusted numbers, not the big headline loss.
Okay, so the finances underneath that XBC charge look really healthy. But financials alone don't make products people want to use.
Yeah.
Let's shift gears. What's actually driving the engagement? What's powering these margins? We need to talk about AI, right? Figma Make.
Yes. This is where things get really interesting competitively. Figma didn't just sprinkle some AI dust on top. They launched a core feature, Figma Make. The idea is it uses generative AI models to help designers get started with app designs, mock-ups, helps get over that blank page problem.
We hear so much AI hype everywhere, but Figma seems to be turning into real usage, especially with their bigger clients. I saw their CEO, Dylan Field, gave a specific number that caught my eye. About 30% of their customers who spend over $100,000 a year with them are using Figma Make every single week.
That's a really significant adoption rate, especially for a new feature aimed at, professional users who have set workflows. And Field was pretty direct about it. He said Figma Make was a big driver of new customers in Q3.
So a direct line from the AI feature to bringing new business in.
Exactly. Product innovation leading straight to customer acquisition.
30% weekly usage among those big spenders.
Oh, yeah.
Sounds good. But with all the buzz around generative AI, part of me wonders, shouldn't it be higher? Like 50%? Does 30% suggest maybe there's still a learning curve or it's not quite essential yet?
That's a fair question to ask. I actually think 30% is quite impressive at this stage. It means it's moved beyond just being a novelty or an experiment for almost a third of their key clients. They're
Mhm.
integrating it. If it were, say, 50% already, it might suggest it was either mandatory or maybe too simple, 30% implies real utility in complex professional workflows. It's quality adoption, not just people kicking the tires.
Quality over just quantity of clicks. And this engagement, it's not just about attracting new people, it's also making their existing customers stickier, right?
Yeah.
Spending more. Which brings us to maybe the most important number in the whole report, for me anyway, net dollar retention.
Absolutely critical metric. For their clients spending $10,000 or more a year, NDR hit 131%. So for everyone listening, that means on average, Figma's existing customers from last year are spending 31% more this year.
31% more.
Yeah. They're adding more seats, maybe buying other products like FigJam, upgrading their plans. It's expansion.
And critically, that 131%, it's actually up from the previous quarter. It was 129% in Q2, so it's accelerating. What do you think is driving that little 2-point bump? Is it just Figma Make or other things too?
I think it's a combination, but that acceleration is telling. It shows their strategy to upsell is working. Things like their whiteboarding tool, FigJam, or pushing people to the higher design professional tier, that's gaining traction. The fact that it's accelerating, not just staying flat, suggests these new high-value tools like Figma Make are immediately feeding into broader adoption and deeper spending within organizations.
Got it. So new customers coming in because of the AI and existing ones spending significantly more. It's like a 1-2 punch for growth.
Exactly, both levers working well.
And that's led them to hit a pretty impressive number of large customers. They now have 12,262 organizations spending over $100,000 a year. That's up about 13% just since the end of June, so in one quarter.
Growing that top tier of customers is exactly what investors love to see. It shows the product really fits the market at scale, which kind of leads to the question, strategically, which do you think management is banking on more for the future? Getting new logos with Make or driving that NDR higher?
Good question. My gut says they're probably leaning more heavily on NDR. Getting new customers is always tough and expensive, but getting 31% more out of the customers you already have, especially now, that shows real pricing power, real stickiness. Let's see if their forecast backs that up. What are they guiding for next quarter? Okay, yeah, Q4 guidance. They're forecasting revenue between $292 million and $294 million. The consensus, LSEG again, was around $283 million, so another expected beat.
Right.
And the middle of their range implies growth is still around 35% year over year.
Keeping growth at 35% as they get bigger, that's a strong signal of confidence. It also suggests their AI strategy isn't slowing down. In fact, it seems to be ramping up, which ties into that acquisition they just made.
Exactly. On October 30th, they announced they bought a startup called Weavy. The description says Weavy's software helps people create images, videos, other creative assets using generative AI. How does that fit with Figma Make, which seemed more focused on the app design, the UI UX part? Is this defensive or pushing forward?
Oh, it's definitely pushing forward. It fills a really important gap, I think. Figma Make is great for the structure, the layout, the user flow, but Weavy seems focused on the actual content within the design, generating images, videos, illustrations directly within Figma using AI.
Oh, okay.
So it moves Figma from being just a tool for designing the interface towards being this unified space where you can also generate the creative assets for that interface. Precisely. Keep them in the Figma ecosystem for the entire workflow. Dominate the whole pipeline. CEO Field said they haven't figured out pricing yet for what they're calling Figma Weave capabilities, but you can bet it's coming. And if they can bundle that kind of media generation into their existing paid plans, well, that's just going to push that 131% NDR even higher, you'd think.
Right. Make the platform indispensable, cover every base. That seems to be the play. Before we wrap up, let's just quickly put their stock performance in context. How have they done since the IPO?
Yeah, it's worth remembering they just went public on the NYSE back in July, raised about $1.2 billion, pricing the shares at $33 each, and the stock recently closed around $44, so that's about a 33% gain since the IPO.
33% gain since July. How's that stack up against the wider market?
It's significantly better. Over that same period, July to November, the NASDAQ Composite Index, sort of the tech benchmark, was up maybe 11%.
Okay, so Figma is delivering roughly 3 times the return of the tech market overall.
They're clearly looking past that big, scary non-cash loss number and rewarding the strong operations and, importantly, that aggressive AI-driven roadmap.
So let's try and boil this down. What's the key takeaway for you, our listener, from this deep dive into Figma's quarter?
I think the main thing is that Figma has really shown how AI innovation, when done right, can translate almost immediately into measurable results. We're talking high-value customer engagement, faster growth, driving both new customers and more spending from existing ones. Q3 proved Figma Make is working, and the Weavy acquisition signals they're just hitting the accelerator harder. They want to be the essential AI-powered platform for designers. That billion-dollar paper loss, it's just noise compared to that core story.
That incredible 131% net dollar retention, which is still climbing, plus the AI push with Make and now Weavy. It really does feel like the design software space could become a kind of winner-take-all race based on who integrates these generative features best. So maybe the final thought for you to chew on is this. Competitors obviously need to match Figma's AI features, that's clear. But the real challenge might be matching the stickiness. How do rivals build tools that not only work, but also convince their existing customers to spend 30% plus more each year? It makes you wonder if Figma's edge isn't just the tech itself, but how deeply integrated they are becoming in their customers' workflows, constantly expanding that relationship.